Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex.
Chicago soybeans. 4 weeks ago, I highlighted a bright pink July 24 to date rectangle pattern, currently 952 to 1094. The top side of this pattern is also capped by the 50% Fibonacci line of the May to August 2024 move at 1098 and a 61.8% absolute Fibonacci line at 1106. Now, separate to this, I brought up 4 weeks ago the idea of a February to date descending wedge pattern. My comments from 4 weeks ago included, and I quote, "A break from this pattern when it comes will be very interesting, as if it were higher, then the 50% Fibonacci line and the 61.8% absolute Fibonacci line overhead would be under threat, whilst a break lower would run into the congestion scene mainly between mid-October 2024 to mid-January 2025 in the 990 zone, assuming of course it pushes past the dark blue neckline extension, that's currently 1017, of the late July to late August reverse head and shoulders pattern," end of quote. Well, 4 weeks ago, and again 3 weeks ago, we had breaks lower and prices dropped down to 991 and 994 respectively. The first one, easily within the influence of what I had said, was the, and I quote, "congestion seen mainly between mid-October to mid-January 2025 in the 990 zone," end of quote. And the second, well, possibly within the same sphere of influence. How with changeover 2 weeks ago, we were back up testing from the top side the combination of flatlining mauve medium moving average, currently 1023, and a dark blue neckline extension. Now, we have left a sort of mini double bottom formed over the start of March, though I did not designate it as such because, as I said 2 weeks ago, and I quote, "I suspect we may extend that into a possible bearish cat's ears pattern, so I'll leave it for now." However, the 990 support is worrisome for anyone looking on the downside. I say this because the primary target on the downside for the small bright green descending wedge pattern, that's this wedge pattern we're talking about, has already been achieved, as it wasn't too far below the break lower down at the 1011 level. However, the secondary harder to reach target X is down at 966, below the 990 level and just above the purple uptrend. That's currently at 959. Of the 2019 to date uptrend and the more recent pink August 24 to date uptrend, currently at 952. I think a lot will depend on whether the market manages now to move back below this dark blue neckline, end of quote. That's quite a long quote with quite a lot to unpack there. So what have we seen since? Well, whilst we have seen a slow, very slow grind lower below the mauve medium moving average and the dark blue neckline, and filling in the changeover gap, but it's been painful to watch as we came to the end of the descending wedge pattern. Then last week, seemingly out of nothing, we had a weekly key reversal up based on the dark blue neckline. However, this week the market has become a little schizophrenic with a daily key reversal up on Tuesday this week, and today a gapping move lower. Thus, I have decided to maintain target X at 966 on my daily chart, but I will put it on notice of possible retirement. You see, overall we are still well within the original large July 2024 to date rectangle pattern. Admittedly a very large pattern, but one I think which is the core pattern to watch here. Chicago soybean meal. The main recent pattern driver here in this market had been, and is still just about, the dark blue May to October 2024 bearish shift pitchfork. The market is running for a third time back below the overhead upper time, currently at 303.40, after breaching it 2 weeks ago with changeover. This pattern had previously been breached on the upside back in January, but it had not been broken, and it had at the time also been reinforced by a congestion area further overhead between 323.30 to 326.90, as well as the declining gold long moving average above, currently at 311.90. In the middle of March, with changeover, prices opened over the dark blue upper time, but the gold long moving average did a splendid job in capping the rise, especially on the Monday, and we are back within the bearish shift pitchfork, as well as under all the moving averages, and we are approaching the December last year lows in the 290.80 zone. Now, overhead we have the interesting mid-December 2024 to early February 25 lower bull channel line come lower trend line to an ascending wedge pattern, currently at 330.30, plus just below we have the lopsided head and shoulders tops neckline, currently at 327.80. 6 weeks ago prices dropped down below both, and as I said 5 weeks ago, and I quote, sets up some opportunities on the downside. For an ascending wedge pattern, there is a primary target X down in the 293.80 zone and a secondary hard reach target X1 down in the 265.60 zone. For a head and shoulders top pattern, we have a primary target X2 down in the 293.30 zone and a secondary hard reach target X3 down in the 280.10 zone. End of quote. I further added, and I quote, looking at the targets, the primary targets X and X2 are doable, but still within the congestion seen back in April to August 2020 between 282 even and 300 even, and again most recently in November and December last year. However, the secondary targets for both are below this congestion and thus harder, much harder to attain. End of quote. We are today still gradually working our way through this 282 to 300 congestion support. 4 weeks ago, upon reflection, I had an interim target X4 in the 285.30 zone below for the ascending wedge pattern. And 4 weeks ago also, we saw both primary targets X and X2 achieved, followed by a reactionary move back up. This move back up created back then a weekly key reversal up, which has seen a small move higher since, including a small bull flag pattern, but which has not lived up to its potential, and we've since fallen almost to the levels seen back at the start of March. Indeed, I said 4 weeks ago when discussing the weekly key reversal up that it was an up, that if it was an up, then I would, and I quote, most likely retire both secondary targets below as well as the new interim target. End of quote. Well, for the last few weeks, I've kept all 3 targets below still on my daily chart, but put them under notice. Now, this week I've decided to only keep the targets below, but I've decided to take away, in my mind, the notice of retirement away from this. Finally, this commentary would not be complete without my discussing the elephant in the room, or at least the elephant in the room which has stayed there throughout 2024 and also resonates now into 2025. And that is the annual key reversal seen here at the end of 2023. I said, and I'm afraid I have to repeat something I've highlighted now for 93 weeks, and so coming up for nearly 2 years, and I quote, I now only need to remind you once again of my words when I pointed out the Chicago soybean meal was about to make that rarest of patterns, an annual key reversal down. This duly came about at the end of 2023, and we've been living in the shadow of this pattern ever since. End of quote. I've also added ever since, and I quote, if there is only one thing to take away from my musings, let it have been those words. End of quote. These last few weeks have shown that the shadow cast by that supremely significant pattern, bearish pattern, so long ago, still darkens the skyline of this market today. Chicago soybean oil. A continuing theme as per the last 2 weeks here of a somewhat clearer chart when compared to earlier weeks. The main pattern here is still the bright red shallow bullish shift pitchfork with a mid-September to late December 2024 move. The market is right now in between the bright red middle tine below, currently at 45.69, and the bright red upper tine above, currently at 50.80. Okay, so recently with changeover, we saw a small gap higher 2 weeks ago, followed by a further move higher over the congestion at 42.52 and 42.67, being the May and April lows respectively. The move up was very unsurprisingly capped during the middle of March on a closing basis by the flatlining long moving average, currently at 43.52, and supported on an opening basis by the 42.52 May 2024 low. Late last week, prices pushed higher over the also flatlining medium moving average, currently at 43.85, lodging right now in between the significant 50% Fibonacci line at 43.80 and the April 2014 high at 43.94, peaking last Friday just over the bright red middle tine. The very early part of this week saw a consolidation at the middle time before a fresh big move higher, all the way up to the significant resistance of the 38.2% Fibonacci line of the March 20 to April 22 move at 48.95. Now, this resistance is significant because it has capped the previous two major rises in July and November 2024, and I also suppose the almost rise seen in February this year. Right now, it seems to be doing a similar job today. Now, as I've pointed out extensively in my previous video commentaries, the market has seemingly decided upon a huge, large-scale June 24 to February 25 triple top pattern that could be now extended to a June 24 to April 2025 triple top pattern, offsetting what could have been a huge June 24 to February 25 double bottom, or even a huger, if that's a word, a huge June 24 to March 25 triple bottom. So once these patterns have offset each other, what have we left? Well, just the main pattern all along, the bright red, shallow, bullish shift pitch hook, at least for now.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.